Okay, let's dive right into this. Welcome to today's Explainer, where we are going to completely unpack a financial reality that might just change how you look at your entire portfolio forever. Now, if you're a mainstream index fund investor, maybe you've been diligently putting your cash into the S&P 500 or an all-country world index. First of all, you are doing a really great job building a solid foundation, but here is the fascinating part. By sticking exclusively to that conventional wisdom, you might actually be missing out on a massive, hidden wave of explosive growth.
And that brings us to a really critical question, and honestly, it's the core of what we're uncovering today. Are you leaving massive profits on the table by only holding the S&P 500 in all country funds? See, there is this phenomenon happening right now in the markets that we call the profit gap. It's basically the vast difference in returns between broad, safe indexed funds and hyper-focused thematic growth funds.
82.59%. Seriously, just let that number sink in for a second. That is the jaw-dropping one-year return of the AI Innovation Index. Imagine your investment nearly doubling in just 12 short months. While the broader market has definitely been climbing steadily, these hidden funds, which are heavily powered by the AI boom, are just vastly outpacing traditional holdings.
So here's our roadmap for today. 1. The profit gap problem. 2. Ranking the top NISA funds. 3. The secret FANG Plus engine. 4. High returns, high risk. And finally, 5. Your ideal investment strategy.
All right, let's jump straight into part 1. The profit gap problem, and missing out on the AI boom. Moving right along to section 2, ranking top NISA funds, looking at the 1, 3, and 5-year data. Okay, so you might be wondering, is this just a short-term fluke? Well, to figure that out, we have to look at the sheer dominance of one specific fund across multiple timeframes. But first, some really vital context here. Over the last year, a literal massive shift has happened. Capital has just flowed aggressively into artificial intelligence and semiconductors. And because of this intense hyper-concentration, standard funds, like the widely beloved S&P 500, actually dropped completely out of the top 5 performance rankings. Instead, the Innovation Index AI is sitting pretty at number 1 across every single timeframe we're looking at here: 1 year, 3 years, and 5 years. It's boasting over 31% annualized returns over a 5-year stretch. That is wild. And notice what isn't in the top 3 at all? Yeah, the S&P 500. Over the short term, we're seeing the Nikkei 225 and emerging markets surging, while over those 3 and 5-year horizons, tech heavyweights like FANG Plus and the NASDAQ 100 easily take the silver and bronze medals. So where exactly is all this market-crushing growth coming from? Well, these returns are highly concentrated. The largest portion belongs to U.S. big tech and AI companies. Think giants like NVIDIA and Microsoft. But here's the kicker. A huge driver of these returns also comes from AI hardware and semiconductor manufacturing over in emerging markets in Japan. Companies like Taiwan's TSMC, South Korea's Samsung, and Japan's Tokyo Electron and Advanatest. They are the ones actually building the physical infrastructure for AI, and they are pushing funds like the Nikkei 225 and emerging market indexes to incredible brand new heights. Which brings us to section 3, the secret FANG Plus engine and its ruthless rebalancing. So we know what is happening, but let's talk about why it's happening, using the famous FANG Plus index as our example. The absolute crucial point here is that high-growth funds don't just sit back and passively hold stocks. They actively and ruthlessly curate them. Let me give you an example. Back in March, the FANG Plus index performed this brutal rebalancing act. They looked at CrowdStrike, a software company whose stock was basically just stagnant. It had actually returned a negative 2% over a half-year period. So what did they do? They completely booted it out of the index right then and there, and they replaced it with Micron Technology, an AI hardware stock that had already surged 3.2 times in value. The result of that swap? From April onward, the S&P 500 grew about 15%, but FANG Plus rocketed up 27%. That is nearly double the performance. It's a complete algorithmic power move designed to stay ahead of the market. Now, how do they actually decide who stays and who gets the boot? I promise you, it is not random. The FANG Plus index consists of just 10 companies. That's it. 6 of those are basically permanent tech royalty: Meta, Google, Amazon, Netflix, Apple, and Microsoft. But those remaining 4 spots, they are essentially a gladiator arena. Companies have to constantly fight to keep their spot by proving they meet strict criteria. They need massive market capitalization, incredibly high daily trading volume, a really strong price-to-sales ratio, which basically means how much investors are willing to pay per dollar of the company's sales, and, of course, exceptional sales growth.
If a company's metrics slip even a little, just like CrowdStrike's did, they are instantly dropped for the next high-growth contender. It's survival of the fittest. All right, time for Section 4, High Returns, High Risk, the reality check.
Look, as enthusiastic as we can be about all this structured growth, we absolutely have to look at the other side of the coin neutrally and honestly. Minus 50%. Yeah, let that number sink in. While hyper-concentrated phones like FANG Plus or the AI Innovation Index have incredible sky-high upside, they also carry intense volatility. During the 2022 interest rate hike cycle, FANG Plus experienced a massive drawdown. It lost about half of its entire value. When you strip away the broad diversification of holding 500 companies and you bet practically everything on just 10 tech giants or a single AI theme, you are going to feel every single bump in the road. And this brings us to a really vital quote directly from our sources. It says, "Do not choose a fund just by looking at the return figures, or you may be forced to cut your losses during a crash." It's so true. Past performance during these massive tech and AI booms simply does not guarantee future results. If you realistically don't have the stomach to watch your portfolio drop by 50%, the danger of panic selling is very, very real. You might end up buying high right in the middle of the boom, getting scared, and selling low during the crash, and that will completely destroy your wealth. So let's wrap this all up in Section 5, your ideal investment strategy, matching goals to funds. How do we actually take all this crazy data and apply it to your real life? Let's map it out. If your personal primary goal is stability and longevity, and your risk tolerance is low to moderate, honestly, you shouldn't feel bad at all about sticking to the S&P 500 or an all-country index. That is your ideal match, plain and simple. But if you're chasing high-tech growth and you can handle a high risk tolerance, tools like FANG Plus or the NASDAQ 100 are phenomenal. For the absolute thrill seekers wanting to ride the pure AI trend with a very high risk tolerance, the Innovation Index AI is completely your vehicle. And if you want moderate risk but really want to avoid U.S. concentration, an all-world 3-region equal fund, which balances the U.S., developed, and emerging markets evenly, is a brilliant, balanced play. But hey, what if you want the best of both worlds, right? What if you want those high returns, but you don't want to bet the entire house? Enter the hybrid investing method. It's basically a 2-step process. Step 1 is your core DCA, or dollar cost averaging. This is where you just automate your monthly investments into a nice, stable mutual fund. You're building your core wealth in the background without even thinking about it. Step 2 is your satellite ETFs. This is where you keep some cash sitting safely on the sidelines, and when those hyper-concentrated tech or AI funds eventually take a massive 20, 30, or 50% dip, you step in and tactically buy in manually. You're mixing that safe, passive automation with aggressive, opportunistic dip buying. So, I'm going to leave you with this final provocative thought today. I want you to go look at your own accounts and genuinely ask yourself, is your current portfolio truly aligned with your ultimate financial goals and your actual real risk tolerance? Are you playing it maybe a little too safe and missing out on the AI revolution entirely? Or on the flip side, are you dangerously overexposed without even realizing it? Use the structure we went through today to really take control of your financial future. Thank you so much for joining me on this Explainers, and keep learning.